want you to write down. Here's 5 simple concepts I feel all investors should educate themselves on. 1, you should always understand what a moat is, because that is what gives a company a competitive advantage. It's the one thing that Warren Buffett loves to talk about. Moat, 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 moat. Number 2 is quality. I'm a firm believer that you don't have to look for the next best Amazon, because Amazon is the quality company. You don't have to look for the next best Tesla, because Tesla is a quality company. You don't have to look for the next NVIDIA, because I think when you find quality, you should stick with it. You should learn what quality is in a business. Next, risk management. That's important. It's understanding, for me, how much am I willing to put in a certain position? How much am I willing to risk on a certain position? And the reason why that's important is because if you have, let's say, $5,000 in your account, I don't think you should put all 5,000 into one thing. Risk management. Am I making sense? All right. Next, the margin of safety is important for me, because that helps us learn how to buy companies at discounts. And one of the things I always say is, if you buy every dip, you're going to run out of chip. If you buy every dip, you're going to run out of chip. Every dip isn't a buying opportunity. And when you plan this game, if you understand value, then you'll understand when to buy. And lastly, this is mine. It is focus on learning what free cash flow is. And that's the money that a company has after it pays everything off, and they can sit that to the side. If that can keep growing, it's a good chance that that business will not go out of business. We trapping or we trapping? Let's go a little further. All right, and I want you to write this down. I came up with this, and it's important. So I always be looking at the women, and they talk about journaling is important. And I started journaling. And I realized that it really makes you feel good. It unleashes something. It's kind of like therapy. It's therapeutic. Jose, do you journal? Don't lie. Do you journal? That means no. And your iPhone? Man, you don't be journaling, man. All right, so what I've learned is the more stuff you write down, the better you are at understanding what's going on. So what happens is we have tendencies. And a lot of times people are investing and they aren't understanding why they're doing the things they're doing, and they don't understand what they're doing. They're just following someone that's doing. Right? So one of the most important things for me was saying, write it down when you purchase a stock and write down when you sold a stock. And you need to write down why you purchased it and why you sold it. Don't just sell it. Whether you're right or wrong. Right? The next thing is the psychology checklist. Write down 3 things that you notice when you make an investment decision. 3 things about yourself that you notice. 3 things about yourself that you understand. What's the process? So for me, I noticed that, like, if I did all the research about it, like, there's something that happens in me when I do all the research and I know I flipped over everything, but I also notice there's a little doubt in me, not to execute, but there's a doubt in me because I realized that once I've done all the research and I feel like I know everything, something in me says I'm missing something. Because the minute you feel, and I learned this from Charlie Munger and Ray Dalio, they say the minute you think you know everything about a stock, you've missed something. And so for me, then I start to look at the inverse, meaning like what can cause it to go wrong. And it isn't until I figure out what can cause a stock to go wrong so I feel fully educated. Does that make sense? I like to learn a company inside and out. So know your tendencies. Write them down. Number 3, make an investing checklist. Like, what is the criteria it takes for you to buy a company? What does that criteria look like? Now you're starting to ask yourself, what does it look like for me to buy a stock? What does it not look like? And if you don't have a criteria, then you freestyle. And if you freestyle, and I promise you, you're gonna lose more money than you make. Number 4, where am I getting the information from? Don't just say trap. Even though I'm pretty good. but you gotta think outside the trap. And number 5, I always create a story around any company that I buy. And the reason why I create a story around any company that I buy, because once the story changes, I now know that I can sell it. And that's so powerful for me as an investor, is because when people say, well, why did you sell it? And I can't paint a picture around why I sold it, it puts me at a handicap. So I want to create a story around every company that I buy, like every company that I buy. And once that story changes, I can now sell it. What also helped me is because once I create a story around a company, and example, I created a story around Apple. And I was like, okay, like I know why Apple moves the way it moves. It moves the way it moves because when the iPhone does well, Apple does amazing. When the iPhone doesn't do good, Apple they're gonna be subpar. So when I see the iPhones not doing well, I understand the story around the business. So now I know how to pivot or not. Am I making sense? So if you can create a story, if you get enough detail to create a story around what it is you like or why you don't like the business, when that story changes, it is okay for you to sell that business. So I want you to write that down, take notes that was something I come up with. Every week in Trappin' Tuesday, I try to present something new that helps you become a better investor for free.
What's good, Trappers, man? It's your boy, the Wall Street Trapper. Right now, I want to invite you to an amazing experience full of value. That is my community, Trappers Anonymous. It's 100% the greatest fundamental investing community on the market. Listen, your portfolio should be a masterpiece. And the only way we get you there is if we help you to learn how to invest with confidence. Now listen, I get it. Like you don't know a lot about stocks, or maybe you've heard people say how much money they lost in stocks, but I can guarantee you, 1, because they weren't in the community, and 2, they lack the information. Our goal in Trappers Anonymous is to help you, really to hold your hand on the journey to becoming a confident investor, learning how to navigate through the different events that the stock market goes through to take you from panic to encouragement. There's no better time than now. This is an opportunity only for those who are willing to be on the journey. So listen, man, click the link below. Come join me in Trappers Anonymous, man. I will see you in one of our many classes, whether it's Moat Monday, whether it's the 2-hour class we do on Sunday, or whether it's just a book club. Everything is geared toward making you a better investor so you can triple your net worth and turn your last name to an asset. It's your boy, Wall Street Trapper. See you in the trap.
All right, so watch this, y'all. Let's get to it. So watch this. So Nike is a brand that we all know, but it is on a 9-day losing streak, and it's the longest losing streak in 25 years, right? It's the longest losing streak that the company has had in 25 years. So watch this, though. Let's go a little further there. So here's what I always go and research, like, what's going on. And so I saw this graph, and the graph said that while Nike is the global market leader, next is the Jordan brand, then Adidas, but here's a brand that we all sleep on, Skechers. Now, if you're in a group, I put Skechers in there a couple, like last week. And it wasn't because of this, it's because I researched companies so much. Now watch this. I didn't realize that Skechers, so Nike is a global brand, but Skechers is a niche brand. They have a certain audience and they serve them well. So when I did the research on it, you know me, I said, okay, let me see, because this is a game of returns. I don't care about, like I always tell people this, yo, I look for the boring businesses because the boring businesses make you the most money. And the reason why they make you the most money is because the boring business often get overlooked by the biggest investors because they go with brand name. So watch this. Nike year to date, means from January 3rd to now, it is down 14%. That means if you own Nike from January 3 till today, you are down on that. But Skechers, from January to now, is up 17%. So Skechers not only beating Nike, but Skechers is also beating the market. We trapping or we trapping? Watch this, go a little further. So I said, all right, well, maybe they just having a good year, right? Maybe it's just a good year, because companies can have good years. This happens. So I went and looked at the 5-year return. So this gives me a body of work now. So in 5 years, Nike is only up 23%. In 5 years, Skechers is up 65%. It more than doubled it. It more than doubled it. And so what I want us to understand is, for me, I don't care about Nike ain't going nowhere. That don't mean nothing to me. Nike ain't making me no money. I don't care if they ain't going nowhere. There's a whole bunch of skaters that say this is what we rocking with. And guess what? They spending money. So what I want you to understand is, here's a gem that I always tell. Once you find a company that's big in the industry, go find out who its competitors are, because the competitors a lot of time can outdo the company. In case you're somebody like Apple or Amazon. Then we talking about a different ball game from performance. But a lot of times, the other companies inside of that industry can be outperforming the big company. And Skechers is a prime example of that. We trapping or we trapping? Oh, so you think they got that? All right, let's go a little further, man. So when I saw this dude come on TV and say this, and I asked the people last night at the elite dinner. Shout out to my people that came to the elite dinner last night. I know I'm going to say something. I told my support team, we're going to get a lot of emails because it was supposed to be 30-something people. I was like, oh, man. So when the guy came on TV and said, we not worrying about the people stealing, I said, oh, he just opened up a door. You supposed to keep that in-house. You don't get on national TV and say that, because you done opened, people starving right now. You don't entice the lion. You don't dangle the meat. You let him do it. So I was listening to, damn, I don't want to say this out my mouth like that. Dick's Sporting Goods. Damn. Listen to Dick's Sporting Goods today, and their stock plummeted today by 24%. And the number one reason, because they missed earnings, they missed revenue, and they lowered their guidance in half. But the number one reason they said was because people stealing too much. They said we can't control it. They say we cannot account for how much people are stealing out the stove. But this ain't the first time I heard that. And so I'm going to tell my trappers this. Until we get in better economic times, I would stay away from the retail sector. Because even Target said it, Gap said it, Macy's said it. It was like, yo, it's the shrinkage and the theft, like we can't account for it. So if I'm y'all, if you already own it, keep it. I'm not gonna say get rid of it. Well, not get rid of Dick's Sporting Goods, but if you own like Walmart or Target or something, I'm not gonna tell you get rid of it, but I would say don't get into a better position with it, because I think this is gonna be an issue until we get in better economic times. Also, the ETF is XRT. I would stay away from it, because this is only going to increase. And this is happening at such a large scale, now it's eating away at the profit. So what slim margins you did have now become null and void, or they become eradicated because people now taking it. Is that making sense?